What I'm about to tell you now is something that most financial news channels, most retirement advisors, and most people you know are not talking about. Not because it isn't real, but because it makes people uncomfortable. Ray Dalio, the man who predicted the 2008 financial crisis before almost anyone else, who has studied every major economic collapse in the last 500 years, is warning that 2026 is setting up to be one of the most dangerous financial periods in modern American history. Not a little dip, not a correction, a structural shift. And here's what almost nobody is telling you. The wealthy already know this. They have known it for months. They are quietly, deliberately moving their money into 5 specific types of assets right now, while regular Americans are still sitting in the same 401k they've had for 20 years. While regular Americans are still holding the same mix of stocks and bonds they were sold a decade ago. The 5 assets we're going to cover in this video are not exotic. They are not complicated. They are not reserved for billionaires. But most Americans between the ages of 35 and 65, people who have worked for decades and have real money on the line, have little to none of them. By the end of this video, you will know exactly what those assets are, why they work specifically in a 2026 economic environment, and exactly how to start moving in the right direction. Stay with me, because this is very important. Before we talk about the 5 assets, I need to give you context. Because if you don't understand why 2026 specifically is concerning to people like Ray Dalio, you won't fully appreciate why these 5 assets matter. Let me explain the 3 forces that are converging all at once heading into 2026. This has never happened before in exactly this combination. Force 1. The debt mountain. The United States is carrying a national debt that has crossed $34 trillion. That number is so large it's almost meaningless on its own. But here's what makes it dangerous. For the first time in decades, the interest payments on that debt are becoming one of the largest line items in the federal budget. In 2024, the U.S. government paid over $870 billion in interest on its debt. That is more than the entire defense budget, more than Medicare. And it is going up, not down. Why does this matter to you? Because when a government is paying that much in interest, it has fewer options. It can raise taxes, it can cut spending, it can print more money, or it can do a combination of all 3. Every one of those options has consequences for regular Americans, for your savings, your purchasing power, and your retirement. Ray Dalio has written extensively about what he calls the long-term debt cycle. He says that when a country reaches the point where debt service costs consume a significant portion of government revenue, it enters a period of forced restructuring. That restructuring is painful, it is not optional, and it is coming. Force 2. The end of the low-rate era. For roughly 14 years, from 2008 to 2022, Americans lived in an era of near-zero interest rates. That era is over. The Federal Reserve raised rates aggressively starting in 2022, and while there have been modest cuts, rates are not returning to the 2010s levels anytime soon. The era of cheap money, the era where you could borrow your way to wealth, where companies could survive on cheap debt, where housing prices defied gravity because mortgages were nearly free, that era is done. What this means for 2026 is a delayed reckoning. Much of the corporate debt and real estate debt taken on during the low-rate era is coming due for refinancing between 2025 and 2027. Companies and property owners who borrowed at 2% and 3% are now facing refinancing at 6%, 7%, and 8%. Dalio calls this the debt refinancing wall, and it's arriving right on schedule. Force 3. Geopolitical fragmentation. The third force is the one that gets the least attention in personal finance circles, but that Dalio considers the most structurally important. The world is deglobalizing. The decades-long era of cheap goods from China, stable supply chains, and dollar-dominated global trade is fracturing. The U.S.-China relationship The most economically significant bilateral relationship in human history is under sustained pressure. Trade wars, technology bans, Taiwan tensions, and competing monetary systems are all pulling the global economy apart. Why does this matter for your money? Because deglobalization is inflationary. When goods cost more to produce locally, when supply chains get reshored, when trade barriers go up, prices rise. And inflation is the silent tax that destroys the purchasing power of savings, bonds, and fixed income investments. Dalio has argued for years that the combination of high debt, rising rates, and geopolitical fragmentation is the recipe for what he calls a paradigm shift. A period where the assets that worked in the previous era stop working, and the assets that most people ignore suddenly become essential. Those 5 assets are what we're covering today. Before we get into the 5 assets, I want to tell you a story, because numbers and charts only go so far. What actually makes this real is seeing it in human terms. This is the story of 2 American families. They're composites, not real people, but they represent thousands of real situations playing out right now across this country. First, the Hendersons, hoping it doesn't happen. Robert and Karen Henderson are 58 and 55. They live in Columbus, Ohio. Robert spent 25 years in manufacturing management. Karen worked part-time as a teacher's aide while raising their 3 kids. Together they earned good money. Never rich, but solid working-class comfortable. Today, they have $340,000 in their combined 401k accounts, mostly in a standard target date fund. They have $22,000 in a savings account. They own a home worth about $280,000 with $90,000 left on the mortgage. On paper, they look fine. But when you look at what their retirement savings are actually invested in, a picture emerges that should concern them. Their target date fund is roughly 60% U.S. stocks, 35% U.S. bonds, and 5% international stocks. They have 0 exposure to real assets, 0 exposure to inflation hedges, 0 exposure to the kinds of assets that historically perform during inflationary debt cycles. Robert has heard about gold. He's heard about commodities. He's even heard the term tips. But he doesn't really understand them. And his financial advisor, who earns a commission on the funds he's already in, hasn't brought them up. If 2026 plays out the way Dalio warns, with a combination of rising inflation, slowing growth, and dollar pressure, the Hendersons, $340,000 could look very different in 2027. Not gone, but diminished, maybe $240,000, maybe less. And with retirement 7 years away, they don't have time to recover the way a 35-year-old does. Second, the Nguyens, quietly moving. Michael and Lisa Nguyen are 54 and 52. They live in the suburbs of Phoenix. Michael runs a small landscaping business. Lisa works as a hospital administrator. Their income is similar to the Hendersons, maybe a little higher. But 18 months ago, Michael sat down and read Dalio's work on the changing world order. He spent 3 weekends going through it. And then he made changes. Not dramatic changes, not panic moves. Methodical, deliberate repositioning. He moved 15% of their retirement savings into a gold ETF. He opened a separate brokerage account and bought an inflation-protected bond fund. He purchased 2 acres of agricultural land in a rural county with a group of investors. He shifted a portion of their bond allocation from long-duration U.S. Treasuries to short-duration international bonds. He didn't go all in on any single bet. He didn't predict the exact timing. He just made sure that if the economic environment Dalio described actually arrived, their savings would be protected and possibly positioned to grow while everyone else was reacting. That's the difference this video is about, not predicting the future perfectly. Positioning intelligently for a range of scenarios. The Nguyen's are not smarter than the Hendersons. They just had the information. And now, so do you. Before we cover the 5 assets, I need to give you one mental model, because without it, you might hear this information and make the wrong moves. The mental model is this. Wealthy people, don't try to predict crashes. They engineer resilience. There's a massive difference between those two things. Trying to predict a crash means you're betting on a specific outcome at a specific time. You sell everything in February because you think the crash is coming in March. But the crash doesn't come in March, it comes in November. And in the meantime, the market went up 18% and you missed it. Now you're worse off than if you'd done nothing. Dalio has been explicit about this in his writing. He says he doesn't know exactly when the next major downturn will happen. Nobody does. But he knows the structural conditions that make downturns inevitable, and he positions accordingly, years before anyone else feels the urgency. Engineering resilience means you build a portfolio that performs reasonably well across multiple scenarios. In the scenario where everything is fine, you still participate in the upside. In the scenario where inflation surges, your inflation hedges protect you. In the scenario where the dollar weakens, your international and real asset exposure protects you. In the scenario where growth slows and markets fall, your safe haven assets hold their value. This is what Dalio calls the all-weather portfolio. And the 5 assets we're about to cover are the pillars of that approach, specifically calibrated for the 2026 economic environment. One more thing before we dive in. You don't need to be rich to use these 5 assets. You don't need to liquidate your 401k. You don't need to make dramatic moves. What you need is intentional, incremental repositioning. Even moving 10% to 15% of your existing savings toward these 5 assets changes your exposure profile significantly. Okay, let's start with asset 1, which is gold and precious metals. The first asset on Dalio's list, and the one he has talked about most publicly and most urgently, is gold. I know what some of you are thinking. Gold? That's old-fashioned. That's for preppers and conspiracy theorists. That's not a real investment, I hear you. And I want to spend real time on this, because gold is probably the most misunderstood asset in modern American financial culture. And that misunderstanding is costing regular Americans money. Why gold? The real answer. Let's start with what gold actually is. Gold is not an investment in the traditional sense. It doesn't produce earnings, it doesn't pay dividends, it doesn't have a PE ratio. Gold is money, the oldest, most universal, most tested form of money in human history. Every major civilization for the last 5,000 years has recognized gold as a store of value. That's not mythology, that's a track record. The reason gold becomes important in a 2026 environment specifically comes down to one word: trust. When governments run massive debts they can only service by printing more money, people lose trust in paper currency. Not all at once, gradually. But as that trust erodes, money flows toward assets that can't be printed, assets that exist in fixed supply, assets that governments cannot devalue overnight. Gold is the primary beneficiary of that trust erosion. Dalio wrote a widely read paper in 2020 called "Why in the World Would You Own Bonds?" In it, he argued that in an era of financial repression, where real interest rates are 0 or negative and governments are printing money to service debt, gold is superior to bonds as a portfolio anchor. That environment? It's not going away, it's getting more extreme. What the data shows. Let's look at the historical record. Because this is not speculation, there is a century of data on how gold behaves relative to other assets during specific economic conditions. During the stagflation of the 1970s, the last major period of high inflation combined with slow growth U.S. stocks lost roughly 50% of their real purchasing power. Gold increased approximately 200–300% over the same decade. During the 2008 financial crisis, the S&P 500 fell roughly 57% from peak to trough. Gold fell briefly and then surged to all-time highs, eventually doubling from its pre-crisis levels. During the COVID pandemic shock of March 2020, gold fell briefly along with everything else. But within months, It hit all-time highs above $2,000 per ounce as central banks began aggressive stimulus programs. The pattern is consistent. Gold underperforms stocks in long periods of stable growth and low inflation. But in periods of financial stress, debt crisis, currency debasement, or geopolitical uncertainty, gold performs. And in 2026, we're looking at a potential convergence of all four of those triggers at once. Central banks are telling you something. Here's a signal that most retail investors completely miss. Central banks, the institutions that control the money supply of every major country, have been buying gold at the highest rates in decades. In 2022, central banks globally bought more gold than at any point since 1967. In 2023, they continued at a record pace. In 2024, the buying accelerated. Who is buying? China, India, Poland, Turkey, Singapore, and dozens of other nations, all of which are quietly reducing their dollar reserves and replacing them with gold. Why does this matter? Because central banks are not sentimental. They don't buy gold because they like shiny things. They buy gold when they no longer trust the currency system they're operating in. When central banks around the world start moving out of dollars and into gold, they are sending a signal that the people running the global financial system do not entirely trust the global financial system. That is not a small thing. That is worth paying attention to. How to actually buy gold. Practical options for regular Americans. Okay, so you're convinced gold deserves a place in your portfolio. How do you actually do this? There are four main options, and they are not equally good for everyone. Option 1 is physical gold. Coins and bars you hold yourself. This is the most direct form of ownership. You own the thing. Nobody can take it away digitally. No counterparty risk. The most common forms are American Gold Eagle coins, Canadian maple leafs, and standard 1-ounce gold bars. The downside? Storage costs money, either a home safe or a bank safety deposit box. And liquidating is slower than pushing a button. But for people who want the most resilient form of protection against systemic financial crisis, physical gold has an argument that no paper version can make. Option 2 is gold ETFs, exchange-traded funds that hold physical gold and trade on the stock market like any stock. The largest and most liquid is GLD SPDR Gold Shares, followed by IAU iShares Gold Trust. These are easy, low cost, and liquid. You can buy them in your brokerage account or even your IRA. The important thing to understand, gold ETFs are not the same as owning physical gold. In a systemic financial crisis, the kind Dalio describes as a tail risk, the ETF is only as good as the institution holding the gold. For most investors, ETFs are a practical and sensible choice. But those who are most concerned about extreme scenarios often prefer to hold at least some physical. Option 3 is gold mining stocks, shares in companies that mine gold. These are more volatile than gold itself. When gold prices rise, mining stocks often rise faster. When gold prices fall, they fall harder. They're a leveraged bet on gold price direction, not a pure store of value. Suitable for investors who want more upside potential and can tolerate more risk. Option 4 is gold in your IRA through what's called a gold IRA or precious metals IRA. This allows you to hold physical gold inside a tax-advantaged retirement account. There are specific rules and IRS-approved custodians required. This is a more complex setup, but can be powerful for older investors who have significant IRA balances and want gold exposure without tax consequences. How much gold is right? Dalio's own portfolio, as reported in Bridgewater's investor letters and regulatory filings, allocates somewhere between 7% and 15% to gold, depending on the macroeconomic environment. His publicly stated recommendation for ordinary investors has been in the range of 5% to 10% of a total portfolio. What does that mean in practice? If you have $200,000 in total savings and investments, a 7.5% allocation to gold means $15,000. That's 2 or 3 American Gold Eagle coins, or the equivalent in a gold ETF. It is not a dramatic move, but it's a meaningful one. Asset 2. Real assets, land, commodities, and infrastructure. Asset 2 is the category Dalio calls real assets, and it's broader than most people realize. The category includes agricultural land, commodities like oil, natural gas, copper, and wheat, infrastructure assets like utilities and toll roads, and timber. These assets share one critical characteristic. They are things, physical things. Things with intrinsic value that exist independent of any currency, any government balance sheet, any interest rate decision. When Dalio talks about the coming paradigm shift, he consistently points to real assets as the category most likely to outperform during periods of high inflation combined with currency debasement. And in a 2026 environment, that's exactly the scenario he's preparing for. Why real assets work when paper doesn't? Here's the simple logic. Inflation means your dollar buys less. It means prices go up. It means the purchasing power of cash, bonds, and fixed income investments gets quietly destroyed over time. But if you own the thing that prices are rising on, if you own the land that grows the food that's getting more expensive, you're not on the losing side of inflation. You're on the winning side. A farmer who owns 100 acres of productive agricultural land doesn't care if inflation is 3% or 8%. His land produces crops. Those crops sell for market prices. As prices go up, his revenue goes up. The land itself holds value or appreciates. He is, by definition, inflation-proof in a way that no bond or savings account can be. You don't need to become a farmer to benefit from this principle, but you need exposure to the category. Land, the original inflation hedge. Agricultural land has been one of the best-performing asset classes over long periods of American history, particularly during inflationary decades. During the 1970s, the last major inflationary crisis, U.S. farmland values roughly doubled in real terms. While stocks were losing purchasing power and bonds were being destroyed by inflation, the people who owned land were seeing their wealth preserved and, in many cases, grow. Today, institutional investors have noticed. Funds managed by Bill Gates, pension funds, sovereign wealth funds, and yes, investment vehicles connected to Dalio's Bridgewater have been allocating heavily to agricultural and rural land across the United States. For regular Americans, direct land ownership is possible, but it requires capital and patience. Rural land in many parts of the Midwest and Southeast can still be purchased for $3,000 to $8,000 per acre. A small parcel of productive farmland, even 5 to 10 acres, can serve as both an inflation hedge and a genuine store of value. If direct land ownership isn't accessible, farmland investment platforms like AcreTrader and Farm Together have made fractional ownership of agricultural land available to accredited investors, with minimums as low as $10,000. This is newer territory. Do your due diligence. But the underlying asset is ancient and proven. Commodities. Owning what the world runs on. Commodities are the raw materials that economies run on. Oil, natural gas, copper, aluminum, wheat, soybeans, gold, which we covered separately, and dozens of others. In a deglobalizing world, which is exactly the world Dalio describes for the coming decade, commodities become scarcer and more expensive. When supply chains break down, when trade routes are disrupted, when countries start building domestic production capacity, the cost of raw materials goes up. Every time. Dalio's Bridgewater has historically maintained significant commodity exposure, and his public writing repeatedly points to commodities as a core portfolio component during inflationary paradigm shifts. For regular investors, the simplest way to get commodity exposure is through diversified commodity ETFs. The two most widely used are DJP, iPath Bloomberg Commodity Index, NPDBC, Invesco Optimum Yield Diversified Commodity Strategy, which cover a basket of oil, natural gas, agricultural products, and metals. Commodity investments are volatile. They don't pay dividends. In periods of low inflation and economic stability, they often underperform stocks. But as an insurance policy against the specific scenario Dalio is describing, inflationary pressure combined with supply disruption, they have strong historical backing. Infrastructure, boring, reliable, and quietly powerful. The third component of real assets is infrastructure. Utilities, toll roads, airports, pipelines, water systems, and telecommunications networks. Infrastructure assets have characteristics that make them uniquely resilient in difficult economic environments. They typically operate under long-term contracts or regulatory frameworks that allow them to pass inflation through to customers. The toll road charges more when costs rise. The utility rate increases when inflation runs hot. The pipeline operator's revenue is tied to the volume of energy flowing through it, not to stock market sentiment. Infrastructure also tends to be essential. People pay their electric bills even in recessions. They drive on toll roads. They use water. These are not discretionary expenses. For regular investors, infrastructure exposure is most accessible through infrastructure-focused ETFs like IFRA, iShares US Infrastructure ETF, or IGF, iShares Global Infrastructure ETF, as well as through master limited partnerships, MLPs, in the energy sector for those seeking higher income yields. How much real asset exposure is right? Dalio's all-weather portfolio allocates roughly 7% to 15% to commodities and real assets, separate from gold. For a 35-to 65-year-old American investor specifically concerned about the 2026 environment, an allocation in the range of 10% to 20% of total portfolio to this category, spread across land or farmland exposure, broad commodities, and infrastructure, creates meaningful inflation protection without excessive concentration. Asset 3. Treasury inflation-protected securities, TIPS, and short-duration bonds. Asset 3 requires a little more explanation than the previous two, but bear with me, because once you understand it, you'll wonder why nobody told you about it sooner. The asset is Treasury inflation-protected securities, or TIPS, and the broader category of short-duration bonds. Let's start with a basic question. What's wrong with regular bonds? The bond problem nobody is talking about. For decades, the standard advice for anyone approaching retirement was to shift money from stocks to bonds. Bonds are safe, the story goes. They provide steady income. They don't have the volatility of stocks. That advice made sense in an era of falling inflation and falling interest rates, which is exactly the era we lived in from 1982 to 2020. When interest rates fall, bond prices rise. When inflation is low, the fixed payments from bonds maintain their real value. It worked beautifully. We are no longer in that era. In 2022, the U.S. bond market experienced its worst year in over a century. Long-duration Treasury bonds fell by 30% or more. People who followed the conventional wisdom, who shifted into bonds to protect themselves, lost more money than many stock investors. Why? Because rising inflation and rising interest rates are the two conditions most destructive to traditional bonds. And both conditions are present, and potentially getting worse, heading into 2026. Dalio has been warning about long-duration bonds specifically for years. His view is simple. In a world of financial repression, high debt, and potential currency debasement, holding a traditional long-duration bond is not safety. It's delayed risk. How TIPS work. TIPS are a specific type of U.S. government bond, but with one critical difference from regular treasuries. The principal value of the bond adjusts with inflation. Here's how it works in simple terms. You buy a TIPS bond with a face value of $10,000. If inflation runs at 5% over the next year, the face value of your bond automatically becomes $10,500. Your interest payments, which are calculated as a percentage of the face value, also increase. So you're not just getting back what you put in. You're getting back the inflation-adjusted equivalent. This means that unlike regular bonds, TIPS cannot be eroded by inflation. If prices go up, your bond goes up with them. You are, by design, protected from one of the primary risks in the current economic environment. TIPS are backed by the full faith and credit of the U.S. government, the same backing as regular treasuries, so credit risk is minimal. The primary risk in TIPS is deflation. If prices fall, the principal adjusts downward. But in the 2026 scenario Dalio describes, deflation is not the concern. Inflation is. Short-duration bonds, why duration matters. Alongside TIPS, Dalio emphasizes the importance of duration management in bond portfolios, specifically avoiding long-duration bonds and favoring short-duration ones. Bond duration is a measure of how sensitive a bond is to interest rate changes. A 30-year Treasury bond has extremely high duration. A 1% rise in interest rates can cause its price to fall by 15% to 20%. A 2-year Treasury bill has very low duration. A 1% rise in rates barely affects its price. In an environment of persistently higher interest rates, which is the 2026 baseline scenario, owning long-duration bonds is a way to lose money slowly and reliably. Owning short-duration bonds or T-bills means your money rolls over frequently, resetting at current higher rates and maintaining its value. This is not exciting. It is not a get-rich strategy, but in the context of a financial crash or a prolonged period of economic stress, short-duration bonds are the ballast in the portfolio, the thing that doesn't sink when everything else is underwater. How to access TIPS and short-duration bonds. The simplest access points for regular investors are ETFs. For TIPS, SCHP, Schwab US TIPS ETF, and TIP, iShares TIPS Bond ETF, are the two most widely used, with low expense ratios and high liquidity. For short-duration bonds, SHI, iShares 1 to 3 year Treasury Bond ETF, and BIL, SPDR Bloomberg 1 to 3 month T-bill ETF, provide exposure to the short end of the Treasury curve. All of these can be held in a regular brokerage account, a Roth IRA, or a traditional IRA. They are not complicated to access. They are genuinely underused by most Americans. Dalio recommends a meaningful allocation to inflation-protected and short-duration fixed income as a core portfolio stabilizer, particularly for investors in the 45 to 65 age range who are approaching or in retirement and cannot afford to take the losses that long-duration bonds experienced in 2022. Asset 4. International diversification. The non-dollar play. Asset 4 is the one that makes a lot of Americans uncomfortable. And understandably so. We live in the most powerful country in the world. We have the world's reserve currency. American stocks have outperformed almost every other country's stock for over a decade. Why would you look outside the United States? The answer, according to Dalio, is not that America is failing. It's that a century of American dominance has resulted in a significant overconcentration of global capital in American assets. And when that concentration unwinds, which it has done periodically throughout history, the reversal can be sudden and severe. The reserve currency risk. The U.S. dollar has been the world's primary reserve currency since the Bretton Woods Agreement in 1944. This status gives the United States extraordinary privileges: the ability to borrow cheaply, to run trade deficits without immediate consequences, and to conduct global commerce in its own currency. But Dalio has dedicated significant research to what he calls the rise and fall of reserve currencies, looking at the Dutch guilder, the British pound, the Spanish real, and other historical reserve currencies that lost their dominant status over time. His conclusion: reserve currency status is not permanent. It is earned, and it can be lost. The conditions that historically precede a shift in reserve currency status: large government debts financed by money printing, declining relative economic power, rising geopolitical challengers, loss of trust in the issuing government's financial management. Sound familiar? Dalio is explicit that he is not predicting the imminent collapse of the dollar, But he is saying that a gradual erosion of the dollar's dominance and a corresponding shift of global capital toward other currencies and assets is a high probability outcome over the next 5 to 15 years. And the early innings of that shift are happening right now, where the smart money is looking. International diversification in a Dalio framework doesn't mean randomly buying stocks in any foreign country. It means identifying the specific structural advantages that other markets offer in the current environment. Dalio and Bridgewater have been particularly focused on 3 international categories. The first is emerging market assets in countries with strong balance sheets. Countries that are not carrying excessive debt, that have positive trade balances, and that are benefiting from commodity exports and demographic growth. India, Southeast Asian economies like Vietnam and Indonesia, and select Latin American markets fall into this category. The second is European and developed market exposure as a dollar hedge. If the dollar gradually weakens relative to other major currencies, as Dalio expects over the medium term, then assets denominated in euros, Swiss francs, or Japanese yen provide implicit dollar protection. Even a moderate dollar depreciation of 10% to 15% adds meaningfully to returns on foreign assets when converted back to dollars. The third is Chinese financial markets, a more controversial and complex topic that Dalio has addressed publicly for years. Bridgewater has been one of the most significant foreign investors in Chinese markets. Dalio acknowledges the geopolitical risks, the governance concerns, and the complexity of the situation. But he also argues that total exclusion of the world's second-largest economy from a globally diversified portfolio is its own form of concentration risk. For most regular American investors, the geopolitical complexity of direct China investment is probably not worth the risk management challenge. But excluding all international exposure entirely, keeping 100% of investments in U.S. assets, is the position that Dalio most directly warns against. Practical access points for international diversification. For most American investors, the simplest way to add international exposure is through low-cost, diversified international ETFs. VXUS, Vanguard Total International Stock ETF, provides exposure to the entire non-U.S. global stock market in a single fund. EEM, iShares MSCI Emerging Markets ETF, focuses specifically on developing economies with higher growth potential and commodity exposure. For currency diversification specifically, protecting against dollar weakness UUP, Invesco DB US Dollar Index Bearish Fund is designed to profit when the dollar falls. This is a more active, tactical position suitable for investors with a specific view on dollar direction. The general principle Dalio recommends: ensure that not all of your savings are denominated in a single currency issued by a single government. Even a 10% to 20% allocation to non-U.S. assets significantly reduces your exposure to a purely American financial crisis. Asset 5. Cash flow businesses and income-producing assets. The fifth and final asset is also the most personal, and in many ways the most powerful. Cash flow businesses and income-producing assets. This isn't about starting a tech company or becoming an entrepreneur in the dramatic sense. It's about the fundamental principle that Dalio returns to again and again in his writing. The most resilient financial position is one where your money generates income streams independent of market conditions, not capital appreciation, which requires someone to pay more for your asset later. Income. Cash. Real money flowing in month after month, regardless of what the stock market does. Why cash flow survives every crisis. Look at every major economic crisis of the last century. Stocks crash, bond values erode, real estate prices fall. Even gold goes through periods of decline. But one thing survives consistently: businesses and assets that generate real cash flow. The landlord still collects rent even when property values are falling. The owner of a laundromat still gets quarters every day, even when the market is down 40%. The person who owns the copyright to a useful piece of software still earns licensing fees. The investor in a profitable small business still receives their profit distributions. Cash flow is the one return that doesn't depend on anyone valuing your asset at a higher price tomorrow. It comes from the actual utility of the thing, the service it provides, the problem it solves, the need it meets. Dalio's principle here is about what he calls productive assets. Assets that produce something, that create value in the world, and that therefore generate returns regardless of financial market conditions. 3 forms of cash flow assets for regular Americans. Form 1. Rental real estate. The most traditional and most understood cash flow asset in America. Residential rental property, a single-family home, a duplex, a small apartment building, generates monthly rent income that tends to rise with inflation, provides depreciation tax benefits, and builds equity over time. The most important thing to understand about rental real estate in a 2026 environment is that rents tend to be sticky upward. Even as property values fluctuate, rents in markets with housing shortages continue to rise. The cash flow persists. For investors who don't want to be landlords, real estate investment trusts, REITs, particularly those focused on apartments, industrial warehouses, and healthcare facilities, provide exposure to rental income through a publicly traded vehicle. VNQ, Vanguard Real Estate ETF, is the most widely held broad REIT ETF. Form 2. Dividend-paying businesses and stocks. High-quality dividend stocks, specifically companies and sectors that benefit from inflation and provide essential services, are a form of income-producing asset that deserves more attention than it typically gets in this context. Companies in energy, utilities, consumer staples, and healthcare tend to maintain and grow their dividends, even in difficult economic environments. A portfolio of dividend-paying stocks with a 4% to 5% yield provides income that grows over time, unlike a fixed bond payment. The principal can fluctuate, but the income stream continues. Dalio's approach is not to chase the highest-yielding stocks. Those often signal financial stress. It's to own high-quality businesses in essential sectors that generate consistent cash flow and share it with shareholders. Form 3. Small businesses and side businesses. This is the category that gets the least attention in financial planning, but that Dalio has consistently identified as one of the most powerful wealth-building tools available to regular people. A small, cash flow positive business, a service business, a vending operation, a content platform, a consulting practice, a specialty trade, provides something that no stock or bond can: direct control, inflation pass-through, and income that doesn't depend on anyone else's valuation of your asset. For Americans in the 35 to 65 age range who have accumulated expertise over decades of working careers, a knowledge-based or service-based small business represents an asset that is extraordinarily difficult to destroy in any economic environment. Your expertise cannot be inflated away. It cannot be seized by a central bank. It cannot be made worthless by a market crash. A plumber, an accountant, a copywriter, a physical therapist operating their own practice. These are all cash flow businesses. They generate income. They have value independent of any market. And in difficult economic times, people still need pipes fixed, taxes done, and health maintained. The principle underneath all 5 assets. Here's what you notice when you look at all 5 assets together. Gold protects against currency debasement. Real assets protect against inflation and supply disruption. TIPS and short-duration bonds protect against rising rates and inflation in the fixed income component. International diversification protects against dollar weakness and American-specific financial crisis. Cash flow assets provide income that persists regardless of asset price fluctuations. Together, they cover all the primary risk scenarios Dalio identifies for 2026. Not all of them will fire at once. In fact, some of them hedge against each other. But that's exactly the point. This is not a concentrated bet on one specific outcome. It's a resilient structure designed to perform reasonably well across multiple scenarios and to avoid catastrophic loss in the worst ones. That is Dalio's core philosophy. Diversify across uncorrelated assets. Engineer resilience. Don't try to predict. Prepare what to do starting tomorrow morning. You just covered a lot of ground. Let me bring it home. Ray Dalio is not predicting the end of the world. He's not saying America is finished or that your retirement is doomed. What he is saying, consistently, publicly, and with decades of evidence behind it, is that the conditions converging around 2026 are unusual, and that the assets most Americans hold are not well positioned for what those conditions may bring. The 5 assets we covered today are not complicated. They are not exotic. They are not reserved for the wealthy. They are accessible, they are proven, and they are actionable. Here is your 3-step starting point, not a 20-step plan. 3 steps. Step 1. Look at what you currently own. Open your brokerage account, your 401k, your IRA, whatever you have. What percentage of it is in U.S. stocks? What percentage in U.S. bonds? How much is in gold, real assets, international funds, inflation protection, or income-producing assets? Write those numbers down. Be honest about what you see. Step 2. Identify your single biggest gap. You don't need to rebalance everything at once. Pick the one asset category from today's list that you have the least exposure to, and that concerns you the most given what you learned, and research one specific fund or vehicle that could address it. Just one. This week. Step 3. Make one move. A small, deliberate move. Open the account. Transfer the money. Buy the ETF. $500. $5,000. Whatever is proportionate and comfortable for your situation, the goal is not to solve everything in 1 week. It's to break the inertia. To make the first intentional move toward a portfolio that's built for what's coming, not what already passed. If this video helped you see your financial position more clearly, if it gave you information that you'll actually use, I have one request. Hit the like button. It costs you nothing, and it directly affects how many other Americans in their 40s, 50s, and 60s get to see this information. There are millions of people approaching retirement right now who need to hear about these 5 assets. The like button is how this video reaches them. And if you want to stay ahead, if you want to understand the next move, the next risk, the next opportunity, subscribe.